Okay, can you hear me now? Oh, success. Tom, I'm glad I can see your face because you're shaking your head back at me, and I appreciate that. How's everybody doing? Good, good. So I actually can't hear anybody, so I don't know if somebody wants to give me a thumbs up or something to let me know to get started. Yeah.
We can hear you.
Chris, how are you? Good, good.
Sorry, give me 1 sec, Nicole.
Take your time. Hello, everybody.
Hey, I'm going to mute now.
Can everyone online see both the presentation, our conference room, and Nicole?
Yes.
You're not online. Okay, thank you. A thumbs up, so.
There's Greg. Hello, Greg.
Okay, so we will go ahead and get started. So thank you everyone for coming to this presentation today. I'm very glad that some board members have attended because this is super important. This is probably one of the most important seminars that we teach throughout the year, and it is about the funds for your association, without which you can't do anything. So super important to have good funds for your association. And Nicole is going to talk about that today. Unfortunately, her flight got canceled, so she's joining us remotely, but we are still happy to have her nonetheless. So I'll do quick introductions, and then I will kick it over to Nicole to start. So for those of you that don't know, I'm Lee Powers. I'm the Chief Operating Officer here at KS Management. To the side of me here is Natalie.
Hello. I just wanted to send out a little bit of love to all of our managers for being here today. For the board members that can't be here, we have our team in place to make sure that they are going to implement a lot of the strategies and the advice that we have Nicole here to present today. So I appreciate all of our CAMs for attending as well.
And as usual, we are recording and transcribing, so we'll send out the recording and all the notes afterwards. So I will kick it over to Nicole to do an intro of herself and then go ahead and get started.
Yeah, well, welcome everybody. Thank you for joining me. I wish I was there in person. Trust me, I tried, but the airlines definitely are not cooperating these days. However, with the beauty of technology, we'll still be able to do this, and hopefully we'll still be able to make it somewhat interactive, because I feel like that is really the best way that we're going to let this information really soak in. So my name is Nicole Melise. I am the Relationship Sales Officer for First Citizens Bank, specifically the Community Association Banking Division. So I focus solely on community associations. I've been in the industry about, I almost don't even want to say, about 19 years. I'm starting to feel very old.
So you started when you were 3?
Exactly. But I it's just proof of how much I absolutely love this industry. I love helping board and managers to be able to navigate the financial environment that is out there. So I do have a little bit of information included about First Citizens and about the CAB division. It questions. We can until the end if you don't. Feel funny about asking questions. There's a lot of information that we're going to cover in over time. So, pens and we'll get started. So if we can switch to the next slide, and actually we'll probably skip right to the third, because we're going to talk a little bit today about investing and lending. So we always like to make sure that everybody's comfortable with.
Nicole, you're breaking up. Nicole, can you hear me?
Let me see, I've got a spinning wheel. I can hear you. Can you hear me?
Okay. You're breaking up super bad, so I don't know if you can move somewhere with better Wi-Fi. Yeah. Not just bad, super bad.
Okay. Super bad. Oh, that's not good. Okay. We are really challenged today with technology on my end. Can you hear me or no?
You're good. Yeah, you're good at the moment.
Okay, let's fingers crossed. Let's see what we can do here. So, again,
Just
I
keep
always
your
just like
left
to make
hand in
sure
the
that you're
air
very comfortable
and-
with the bank itself because of the, am I still cutting out? No? Good?
Nope, you're good.
Hopefully. Okay. Okay. Because of the fact that we don't have a lot of brick and mortar locations within the central part of the country, a lot of times I hear of First Citizens Bank, where are you? I've never seen you before. So just a little bit about the bank itself. We are a top 20 bank in the United States. I believe we're somewhere around 15 for this year. We're on Forbes list for that top 20. We are a client-centric bank. We are a family-run bank. So the family that originated the bank is still heavily involved. So we're in our 5th generation that's starting to move its way through the ranks. And even though it's family run, it is publicly traded. I always encourage everybody to check out the stock price because it does speak to faith within the actual company itself. And the company's been around for about 126 years. We're about $230 billion in assets and just an incredibly strong bank. The chairwoman, vice chairwoman of the bank, Hope Bryant, directly oversees our division. And she was named #1 woman to watch in banking. So the bank itself is a powerhouse. And you'll see that most of our locations are around the perimeter of the United States. We are starting to expand into the central part of the country through acquisitions. We can go on to the next slide. And on to the next one. I'll tell you a little bit about our actual division as well. So we're an $8 billion division of the company. There's about 16,000 employees. Our division has about 210 that are dedicated solely to helping community associations and management companies across the United States. So we have about 42,000. That number has definitely climbed since, probably about 43,000 community associations that we serve, along with about 1,300 property management companies. So we've been in this about 25 years. We were previously Mutual of Omaha and then became CIT Bank and now First Citizens. And we hope that that is the last move. So on to the next one. Okay, so reserves. As Lee mentioned, this is the most important thing. Most important topic is to be able to have reserves when you need them. So I know KS's practice is to make sure that there are reserve studies, that they are updated regularly, and that is the best guidance that any management company can give to any association. That helps to give a 30-year picture, to give an idea of what projects are going to come up and when, and how much the increases need to be able to make those projects happen according to the plans. So then, but when it comes to financials and board members, we know we have board members that come from all different walks of life, maybe not super comfortable with the financial end of things. We're talking multi-million-dollar portfolios when you include the cost, the price of the housing itself. And many times the deposits, the operating reserve account and CDs can be substantial. So what do you do with that? How do you comfortably handle that and fall under the fiduciary responsibility of a board? So FDIC, now it is on the slide. However, I still always like to ask it. What is the FDIC limit? How does anybody want to yell it out in the audience?
250.
250. Tom, winner. So 250 per tax ID per financial institution. And that is the piece that sometimes we all in the past have gotten a little maybe fuzzy on. A lot of times I'll see an account that maybe is pushing that 250 limit and board will say, well, let's just get a CD. If it's still in that same financial institution, it does count towards the FDIC coverage. So we always want to make sure that we look at the cumulative picture of the FDIC. And just understanding what the FDIC is, it's insurance in case of a bank failure. So if a bank's to fail, the funds would be covered up to $250,000. Now, historically, recently, since 2003, it has been proven that when a bank fails, there will be other banks that will pick it up. So they don't really fail anymore. The government won't really allow it. However, as board members, it is likely still in your governing documents or your bylaws that you have to have your funds protected. So that's always what you want to go by, is what is written, and that's what you want to follow. In some cases, it may say, make sure that your funds are fully FDIC protected. In other cases, it may just say protected. If it says fully FDIC protected, when we talk about brokerage funds in a little bit, that is a consideration that you would have to pay attention to. But as long as your funds are fully protected, you are, as a board, doing the right thing. And it can be challenging for associations because you can easily hit that $250,000 limit, depending on how big your association is, how long it's been in existence, the capital improvement projects that you have on the horizon that you've been saving for. So there are many different factors that can play into it. But we just want to make sure that at the end of the day, that you have full protection for your association's funds, despite what may or may not happen in the world. Just, we want you to follow your governing documents and your bylaws. So the next slide is an example. And it's one just to show that there's not a major fear when it comes to FDIC. With Silicon Valley Bank in 2023, I'm sure everybody's familiar with this story, where the bank itself failed overnight, unexpectedly, very quickly. And I can tell you that was an extremely strong bank prior to, and still is. We actually, First Citizens Bank actually purchased Silicon Valley Bank during that failure. The FDIC and the federal regulators reached out to First Citizens Bank directly to save that bank and protect that bank. And that is the 14th bank that we've actually saved from failure throughout the duration of the time that we've been First Citizens. So it's just, I use this example because it is proof that when something bad does happen to a bank, there are other banks that will absolutely step in and purchase a bank. But again, your FDIC protection or your fiduciary responsibility, we want to make sure that no matter what, you always have your FDIC protection. So we can skip on to the next one. And then I'm going to quiz you guys again. So every state actually does have a slight nuance with this. So I'm curious, in the state of Michigan, if somebody feels comfortable sharing what they believe the fiduciary responsibility is. And so if nobody wants to, that's okay. And if we skip to the next slide, I'll get into it a little bit. But ultimately, what we want to do is encourage board members to make sure that funds are protected, that you have liquid needs when you or liquid funds when you need them, and then look at your interest rate, and you want to have competitive returns. Your goal is not to make millions of dollars. Your goal is not to be risky and make up for maybe some past decisions that were made. Your goal is to be safe with those funds and to make sure that you have the funds that you need for projects coming up the best that you possibly can. So when you look at your documentation, the state statutes, governing documents, that should lay out how you as a board in your association should be handling your reserve accounts. You always want to have preservation of principal. So we always want to be careful with what we're doing so that there's no risk of principal or a minimal risk. There's almost always some level of risk, but a minimal risk. And then you want to definitely, if you don't have an investment policy, you'd want to talk to your manager about developing one. And if you do, you want to review it, kind of want to review it somewhat regularly to make sure that it's keeping up with times. And then your reserve study is absolutely key. I can't tell you how many times I've had conversations through the years where a board member will say, I don't want to spend the money to have a reserve specialist do this. I'm going to go to Home Depot, or I'm going to look at our historical info and just update it. That little bit of savings I've seen be detrimental to associations. You need to have, I shouldn't say you need to, but we need to involve professionals that are trained in best practices and reserve study practices across the United States to be able to make sure that we have accurate numbers for you to be able to plan off of. So when we look at reserves, to be able to meet all of those requirements, we have 3 rules. And the number one is protection and coverage. And I use protection in two ways. First, I always look at board members, your volunteers, you're giving up your time. We don't want you to have to give up your personal information as well. And what's beautiful is the relationship that we have with KS. We have our agreement with KS. KS has their agreement with all of the associations. That enables us to be able to work with authorized contacts within KS so that when we get an order from an association or direction from an association, you don't, as board members, have to provide your personal information. They are acting on your behalf with your authorization through written instruction. That allows you to save your personal information. If you hit the FDIC limit, or if you go out to another bank and want to open up a CD, you're likely going to have to provide your own personal information to be able to establish those accounts. And then you're also going to have to worry about updating signature cards throughout. That's an extensive amount of work, or can be an extensive amount of work for board members. So we try to simplify that process, but in turn protect you as individuals. And then the other part of the protection is obviously the FDIC protection. And then second, whenever we're talking about reserves, you want to work in the liquidity that you need. So any liquid periods, if you know you have a project coming up in 6 months, we want to time it. If we're going to purchase CDs, we want to time it so that they're liquid when you need them. Or if you have a project coming up quickly, we want to make sure that we have your funds liquid that you need and protected at the same time. And then third, and I know it's usually number one in everybody's mind, is what is my return? But for the third, it is the third concern would be what the interest rate is that you're going to get. So number one, first, you always want to figure out protection, then liquidity, then the best return that you can possibly get for that duration. And as long as you're staying safe with the products. We can skip to the next slide. Okay, so these are just a couple of quick solutions for deposits. Nothing's going to be overly exciting. I'm not going to spill secrets on how to buy Bitcoin or do anything with the stock market that could potentially be risky. These are all going to be fairly basic terms that you're familiar with. A few new terms that might be new to you, but we'll walk through each of them, and I'm happy to answer any questions about them. But a money market account, as everybody knows, similar to a savings account. It truly is a savings account. You'll earn higher interest, but it does count towards the FDIC within that particular bank. Certificates of deposit, CDs, that is majority of the time, everybody's pretty familiar with a CD. It's a termed product. As long as it's not a brokered CD, you can usually find out what the penalty would be if you had to redeem early. So those are safe products for associations because you have a guaranteed return and minimal risk and a calculated risk, a risk that you can actually know what that number would be. And that's a big piece, a very big piece. And we'll talk about that a little bit more in a couple of minutes. And then laddered CDs are just a way of structuring CDs in a way to make sure that you have liquidity throughout the year. And sweep accounts allow you to have funds in excess of the FDIC, where you're sweeping funds in and out based off of thresholds. And those funds that are swept out are held at other financial institutions, kind of a way of babysitting each other's funds. But it allows you to have a substantial amount liquid. So when you have a capital improvement project and you have to have a fair amount liquid during that time of construction, it's a great solution because it allows you to have those funds liquid but still protected. And we'll talk a little bit more about that in a couple of minutes as well. On to the next. Okay, so we have the two buckets, the within 250,000 within the FDIC limit and outside of that 250,000. So within, as mentioned, CDs, laddered CDs, and money markets are going to be the best way that you're going to be able to get a little bit more interest return. And obviously the money market is fully liquid, so your funds are always available. And then your CDs are always dependent on what term you select at that time. And then you have the over 250,000. I'm going to use a few terms, but we do have a couple follow-up slides that'll show some graphics because I am a visual learner. So I'm a big fan of having pictures. But FDIC, so if you're over the FDIC, there are two options. There's the liquid option and a termed option. So the liquid option is called an insured cash sweep. And this basically is an account that is connected to an operating account or a checking account within First Citizens. We connect what's called a sweep account, and we set thresholds. We set a low threshold and a high threshold. And as funds are deposited, if they are over the FDIC limit, they get swept out. And as checks are written or money is moved, if you hit the low threshold, funds will sweep back in to bring you back up to the threshold that you need to be. Those are typically fairly involved just to make sure that when we set them up correctly based off of all your other deposits that you have, and in a way that the funds are available when you need them. So usually whenever a sweep is going to be involved, again, if you have a project, if you get a large deposit from an insurance company, whatever, if you have an abundance of liquid funds that you need to keep liquid, then we can absolutely set up a call and talk through the details of how we should set that up to make sure that it functions the best for you. And if you know what you can lock up, which most associations do, when associations have a reserve study or a 5-year capital plan, or even just planning out the next 12 months, you typically know when you're going to start projects, what those expenses are kind of going to be. So you usually have an idea where you could be comfortable enough to purchase CDs. And honestly, that is where you're going to get the best return. So wherever you can, we want to encourage you to do it, but we want to make sure that it's liquid when you need it. And the Cedars is the version of a CD that has the additional FDIC protection. And that's called a Certificate of Deposit Account Registry Service. And that's basically a certificate of deposit, just like a regular CD. But we work with a company called Intrify. And Intrify is a logistics company. They match make us with other banks to babysit each other's funds. So if I say to Intrify, I have $1 million that I need locked up for 52 weeks at 3.25%, they're going to go out to however many banks they have to match that order. But you're just going to see one statement, and that statement is going to look like one CD. It will tell you where the funds are held, and you'll get monthly statements for that. But that's able to be controlled and ordered directly through KS like you would a normal CD. So if we had $1 million, you have to go out to a minimum of 5 banks to be able to make sure that that $1 million is fully FDIC protected. That's a nightmare for a board member. That's a nightmare for anybody, but that's a nightmare for a board member when you are volunteering your time to go out to 5 different banks, provide possibly your personal information, have to track down statements monthly, reconcile it, keep an eye on it to make sure no fraud has been happening. So that's a lot of work for a board member to have to do additional work. So by utilizing Intrify and the Cedars or the ICS, you're able to accomplish all of that, but just through one hub, through one email, through your manager, through the accounting team at KS, which makes things a lot more safe and convenient, transparent. Any questions about ICS or Cedars? No, not yet. Somebody.
Does a board member control what banks, at what interest rate, and for what term if they put their money into a CDAR?
Great question. So we can control the term and the rate. It would be whatever the rate is available at that time for whatever the terms are that are offered. But we can't pick the banks. We can include an exclusion list. So if there's banks that you absolutely don't want funds with, we can exclude, but we can't pick them. But they are all FDIC protected.
Okay. Okay, thank you.
Nicole, how are you compensated for these services?
So actually everything we do is free of charge. So the bank has structured it in a way where we a couple of things. Banks make money off of the fact that they can lend. So any deposits that are in the bank are always good for the bank because they can take that percentage and lend it out. And that's where the bank makes majority of the money. And then in one place you'll see, and I'm sure you've seen this, our money market rates are not very competitive. And that is where the bank makes up a little bit more. The good thing is the CDs are very competitive, but the money market rates are a little bit lower. So that's why we like to strategically meet with boards and work with the managers and the boards to maximize your return wherever you possibly can.
Thank you.
Yeah, great question. Okay, we can skip on to the next slide. So this is just a little bit of some details when it comes to utilizing IntraFi, whether it's through Cedars or ICS. And many banks participate in this program. We all have to pay to play to participate in it. But these products can protect between $10 to $30 million, depending on which product it is. So it's peace of mind for the associations. So the Cedars are in weeks, not months. So you'll see 4, 26, 52 weeks. There is no grace period for Cedars. So no matter where you go, your grace period, it is always a set date. They are fixed rate CDs, which is peace of mind for an association. You definitely don't want variable. And then there's ladder options that are available as well. And with ICS, again, it is connected to a checking account. Those rates can fluctuate. They don't often, but they can definitely fluctuate. But you can have up to $10 million of liquid funds in the accounts, and they will be protected and fully liquid. On to the next. So how the sweep works, and I kind of touched on this a little bit, but just so that you have the visual. When, let's say we have $100,000 threshold for sweeping out and a $50,000 for sweeping in. If there are some deposits, it's early in the month, and there's some deposits that hit 125,000 that night, 25,000 is going to sweep out to another financial institution, and the other 100,000 will remain where it is, and that 25,000 is there ready to sweep back in at any point. If we get down to that 50,000, let's say you have a project, you write some checks and you're down to 25,000 and there are funds out in that sweep account, they will sweep in to bring you back up to the threshold. And again, IntraFi is the logistics company. They handle the communication between the banks and the coordination between the banks. So sweeps can actually change bank nightly. With a Cedars, once you know which banks you're in them. With the sweeps, because it's liquid, that can actually change could potentially on a daily basis. It doesn't, but it could. And it's just the banks matchmaking, babysitting each other's funds to make sure that they're always under the FDIC protection. So when we utilize IntraFi, there's peace of mind of knowing no matter how much we put in there, their only goal is to make sure that everything is fully FDIC protected.
I have another question on the CDAR.
Yeah.
How soon do you have to tell them? Let's say you have a ladder that is a 7-month period. How soon before the end of the 7-month do you have to tell them not to put it back into a ladder CD because you have a major project and you need the money out?
Great question. So ours are the Monday prior to maturity. So if it's going to mature tomorrow, I had to let the bank know, our team know by Monday of this week. Otherwise, it will automatically roll. And that is the one thing with all of our products. And we'll talk about brokerage and the difference between the two. Ours automatically always roll unless we're advised differently at opening, which you can do. But they will auto roll. And with a Cedars, because it is through IntraFi, there are hard penalties with that, but they are determinable penalties. So we can always give you the penalty schedule. So you have an idea of, okay, if we had to break this, what is the penalty? And it's duration. So if it's a 1-year CD, it may be 6 months of interest. So it is very important that we keep aware, but we do send notification 3 weeks prior and then another week prior to make sure that you know that it's coming up. And I know KS is very on top of with their financials in the reports, including the CDARs and the maturity dates as well.
Nicole,
Thank
who do
you.
you notify?
I'm sorry?
Who do you notify?
So we automatically send it to the management company, but we can include board members as well. Yep. So you just let us know, hey, we want to be included on the notification and we take care of that. Okay, I think we can jump to the next one, which I believe is Cedars, a little visual on Cedars, or and Cedars and Intrify in general. That if that to just reiterate the fact that they're going to make sure that everything is FDIC protected with wiggle room. So a little bit of room for interest growth. So they're going to place up to maybe let's say you have $1 million, they're going to place up to 230,000 within a financial institution to make sure that you have room for the interest, and they're going to push other funds into other banks. So again, you may see a list, that account registry as part of that Cedars, that will break down the different banks, and it will always indicate the term and the rate for you as well. But it's always protected. And we did see that when the banks failed in 2023. There were a few banks that did have funds that our associations had, and they just shifted everything overnight and sent us new notifications of where the funds were. So they were very on top of that protection. And we can go to the next slide as well. The company used to be called Promontory. It's been around forever. Sweep accounts have been around forever, but they used to pay terrible interest rates. So we never really saw associations take advantage of them. But now that they're competitive interest rates, I can't encourage it enough. In my first couple of years in this industry, I never talked about them because the rates were terrible. But now it's a great solution. And with fraud out there, especially with associations and timeframes of getting funds returned, it's incredibly important that you try to keep your funds as consolidated as possible so that you can keep an eye on them easily and on a regular basis. So again, just some reiteration that it's Intrify, you really look at it as one bank, one relationship. You'll see the Intrify information on the statements, but you're really working with us directly. The funds are automatically there for the sweeps, and you may see on the balance sheet an operating account and then a shadow account with a similar last 4 digits of the account. If you have a shadow account, that just means held in the shadow account are all the funds that are held out at Intrify. So it gives you your overall relationship balance with whatever's in that operating account that's connected to that shadow account. So you're able to see the total of all of your funds at any given time. And next one. So I have a little test. If you want to go to the next slide, this is just a little example of a balance sheet. I created all these associations off of all the teams in the area. But what I wanted to do is just test and see, when you're looking at the cash balances at the top, any red flags that jump out that anybody's willing to yell out. I'm going to put Lee on the spot. His past banking experience.
I have old eyes, so I have to move closer.
I think it might be a little blurry too. I'm just teasing.
So
I'm not
the
gonna
second reserve account is very close to the FDIC limit.
Yeah, and that's the big one there, because there is a CD, and when that CD comes up for maturity, if I was looking at this, if somebody sent it to me and said, hey, this association is over the FDIC and likely has some funds that could be earning better interest, I'm going to look at this and say, okay, you have a CD coming up. When that comes up for maturity, let's turn that into a Cedars. It's an easy switch. And 9 times out of 10, if you ask me nicely, I can likely get that rate exception to match the rate that's in our internal CAB CDs, because there's a slight, usually 5 or 10 basis point difference. And that's where the bank makes up some of the money that they have to pay to play as part of the Intrify program. So that little bit of interest difference, I can usually get a rate exception for you. But that I would first turn that CD into a Cedars when it matures. We'd let it get through maturity, so no penalties. And then, yes, Lee nailed it. It's the reserve account has 248,000. Unless you need those liquid, we can put some into a Cedars, but I would definitely encourage an ICS in that situation. And if we just convert the account into a checking to be able to connect the reserves to it, and that's the nuance that you don't need to know how the sausage is made, but that is ultimately what we would do. And then we would set thresholds and sweep the funds in and out. So there are some easy, simple solutions that we can do to help associations get back under the FDIC pretty quickly. So this one is one example, and I think I have one more example in there. And this one's a little bit more complicated. However, this association has a lot of Cedars. So from a certain, I believe it is from, let's see, from 1112 down is all Cedars. But if you look at the accounts above that, anybody see any red flags in those accounts above it?
$500,000.
$500,000, yes. So even if each association could have up to 250,000, this one is double. So we would want to look at that and say, why do we have those funds liquid? How long do we need them to be liquid for? And if at all possible, can we put them into an ICS, or can we invest them for you and help you to get a little bit better interest? So, so it always depends on what the needs are of the association. There's no blanket answer across the board that I can tell anybody. It always depends on every year changes for an association. The needs change. So we always have to revisit these. It's never a one and done, but there are definitely ways that we can get Tiger Trail a little bit safer and possibly some more interest. So just some things to look at and keep in mind while you're doing it. And that was great. Everybody passed. So we'll go on to the next one.
A quick note for Nicole. She'll meet with boards, and she will put together presentations and ask, what are you using your funds for? How much do you need in certain time periods? What projects do you have going on? And she'll analyze all of your accounts and give recommendations of where to earn the best interest, where to protect money if need be.
Yeah, and we do that all complimentary.
Nicole, you said something that kind of scared me, so I wrote a note.
Uh-oh.
Fraud, Cedars and sweeps, you said are susceptible to fraud. Explain that to me.
Okay, so I may have misspoken. So not necessarily sweeps aren't susceptible to fraud. Pretty much the honest truth is any account can be susceptible to fraud depending on so many different factors. So fraud is, and I know a lot of the managers have sat through a presentation that I do regarding fraud. Fraud is on a major increase, on a major climb. What we notice is that sometimes reserve accounts are hit, and we don't know how thieves have figured this out, but reserve accounts can be hit. And because they're reserves, a lot of times associations will maybe have an account that's the reserve account, and they know that they're not touching it for a while. So they may not pay close enough attention. And if fraud hits that account, it could be months before it's noticed. The IntraFi network is an incredibly safe network. The bank is incredibly focused on fraud protection in every way imaginable. All banks right now are heavily focused on how to protect against fraud because it is getting so bad. But what I love about IntraFi is you can see all of your funds on a daily basis. The management company can absolutely see access on a regular basis of all the funds that are out there. So if something looks off, there's a better opportunity of being able to catch it. If a board goes out and opens accounts at different banks and the management company doesn't have access, they can't help you to be able to keep an eye on that. That would be the board's responsibility.
If the board, through their property management company, went the CDAR route, then wouldn't it be that property manager or the financial institution they pick that would be responsible for making sure that those accounts are safe?
So it is still, so it's a great question. It's an all hands on deck kind of thing, in all honesty. The banks have protections in place. KS has protections in place with the bank that not every other management company does. So that definitely helps to protect the funds and catch fraud early. But there are definitely times where things, where there's dishonest action and it's not caught in time. So it's,
okay.
I haven't had it happen with the Cedars yet. Anything internal, I have yet to have a CD or a Cedars impacted, but I have seen operating accounts impacted, and so that's what we keep an eye on. So by having things in one place, one hub, one statement, one place to look, it alleviates a lot of the risk that could be out there if there aren't enough eyes on those accounts.
So here's the $250,000 legal question. If our association puts their money into a CDAR, we're protected by FDIC up to $250,000. If we keep all our accounts below that, we're safe.
Yes, except FDIC is only for bank failures and not for theft.
Okay. That was the
Yeah.
$250,000 legal question.
Yeah. So, okay, well, we still have a fair amount of information to get through, so I'm gonna hold any other questions for a couple of minutes while we dive into, I think we're ready to jump in a little bit to lending. Oh, nope, we're not yet. So some things to take into consideration. When I talk to a lot of boards that have funds or interest in brokerage firms, I've had some that talk about stock and Bitcoin. That scares me. Some bylaws do actually allow it. I've seen associations where they'll allow 30% to be invested in the stock market. That's incredibly dangerous. One of the major parts of fiduciary responsibility is to minimize the risk of principal, and something like stocks or Bitcoin, you can't do that with. So as a board member, it's something that you should absolutely push to the back of your minds and not consider. Do it for yourself if you want to, but not with the association funds. The association funds, you want to be incredibly careful. Brokerage firms can offer options for boards. Treasuries and bonds are two options that are safe for associations. They're not something that we handle directly. If you are going to a brokerage firm or considering one for treasuries or bonds, you want to ask the question, why? Why do you feel the need to get the bonds or the treasuries? Is it for short-term or longer-term investment? Are they competitive enough? Is the reward worth the risk? There we go. So you want to figure out why you're making that decision, because most of the time, the safest and best route for associations to go is a typical CD. When you have a brokered CD in a brokerage firm, there's a couple of risks that come into consideration. One is that a CD can be callable. And we saw this a lot during COVID, where a lot of associations had great interest rates, like 7-8% through a brokerage firm. But because the Fed rate had dipped to zero, if the brokerage firms had their CDs as callable, which would be a date usually in the middle range of the maturity of a CD, they can recall a CD and not give you anything for it from that point forward. So if you have a 5-year CD, they can potentially call it 2.5 years in. And if you were banking on an 8% return, and now there's a 0 return for the next 2.5 years, you're not. It's going to be detrimental to your plan. If you're banking on those funds to come in, and the brokerage firm calls them, then you're out that interest. That's one risk. Another risk is the secondary market. So CDs, when they're a brokered CD, typically have a secondary market. They are often also provided a little higher interest rate, and that's because there's a little bit of risk that comes with them. If you see that CD through maturity, you'll get the interest rate. If you have to sell it early, you're subject to the secondary market rate. And many times that is not dollar for dollar. I've seen you'll see it as an unrealized loss or an unrealized gain if it's over the dollar amount or under the dollar amount. But if it's under the dollar amount, you are impacting principal. And I've seen associations lose upwards of $30,000 by having to redeem CDs early, brokered CDs. That's why when you're talking about CDs, unbrokered are the safest way to go, because you will have a penalty that you can calculate. So you will have a worst case scenario. Typically that is around half of the time of the CD length. So you just have to make sure that you hold that CD through that time frame so that you don't impact principal at all. But that is the lowest form of risk for community associations. Within First Citizens, we actually do have a wealth management division that does brokered CDs. I have yet to put one of my clients over in the wealth management division because I personally, with my experience in this industry, there's just that much extra risk that's not necessary. You're still going to get a very competitive rate internally, but you're also going to have that protection and a penalty that you can actually calculate, which as a board is a huge, huge factor that you have to take into consideration. Never want to impact principal if you don't have to, but you also never want to take any additional risk if you don't have to. So just and the next slide, I believe, has a little table. We'll share the slides so that you have this table handy. It just walks through the different considerations, risk level, FDIC versus SIPC. If your governing documents say that the funds have to be fully FDIC protected, SIPC could be considered a violation. You'd want to talk to your attorney, your association attorney in that case. Principal stability, liquidity, income potential, fiduciary agreement. So you can see the difference between a bank. Brokerage would depend on the actual vehicles. So if it's bonds, treasuries, or brokered CDs, and then stocks and Bitcoin. But we'll share this with everybody so you can look at it in a little bit more detail. Okay, now we flip to what could be considered a little bit of a heavier topic. However, it's not as heavy as everybody thinks it is. I've gotten on board calls where they've been disgruntled, to say the least, that they have to talk about a loan. A loan is not a bad thing. It's not a 4-letter word. Well, it is, but it's not a 4-letter bad word. And it is something that helps a lot of associations. And sometimes it's just a safety net for associations so that you can have a little bit more peace of mind. But if we go on to the next slide. So usually we've seen loans for every type of capital project, for every type of need for an association, whether it's underfunded from past decisions, or fully funded and just want to have a little bit of a safety net or make it a little bit easier for the homeowners to make their payments. And others where it's just truly a safety net, a line of credit in case winters are worse than anticipated, or there's an insurance situation. I have one that I actually met with this morning, a board that is doing a roof replacement, and they're going to have solar panels. They have a cost estimate. They had some options for funding that were actually pretty good, very competitive, but they have the funds in their reserve account and then some to be able to do the project. That's what the funds are there for, is to be able to do that project. So at the end of the day, they were exploring an option for loans, and they were also talking about a line of credit to be able to just, if they wanted to use their reserves, to know that there's funds there in case they needed them. And at the end of the conversation, and this is just how honest we'll always be with you, it didn't make sense for them to do a loan currently, but it does make sense for them to know that they have the option for a line of credit to be able to fall back on if they needed it. So just some things to keep in mind. What the loans can do, they can help with liquidity in case that's needed. And we put happy homeowners because of the fact that you're usually, when you're doing a project, it's to improve the association, to repair something in the association, keeps the homeowners happy. Happy homeowners make a happy board makes a happy manager. So we like that combo. And then the ability to finish projects. Many times associations, if they don't have the funds, will phase out projects. And if you do cost estimates on that, when you're phased, you're talking mobilization and demobilization multiple times. Maybe the cost of goods can go up, the cost of labor can go up. So if you're taking on a project, if you can do it all in one phase, it's going to be more cost effective and likely keep your homeowners the most happy because you get it done and get them out. So a loan can absolutely help in a situation like that. Curb appeal, huge. Obviously, you're trying to keep your community looking the best that it possibly can. And then to give homeowners options. This is a big piece. If you're taking on a large project, you know your personal situation. You may have an idea of the other board members' situations, but nobody knows everybody's situation in the association. So having a loan can sometimes make it so that you don't have to do a special assessment, maybe not as much of a special assessment, maybe no special assessment at all. Or if you do have to do one, you may be able to expand it out over time to lessen the individual burden on the unit owners, so that you're, you're looking like you're just forcing it down their throats. You're providing them the best possible to be able to keep the association in good shape, good financial shape, but you're taking them into consideration as well as individual unit owners. So we can go on to the next slide. And the life cycle of a loan, just to give you an idea of the process, usually what we like to see is that the association has done due diligence. It's hard if an association comes to us and says, what's the most you can give us? The bank looks at that and says, okay, they don't know what they need yet. It's better to come to us and say, we're looking at a project, we've got bids around 750,000. How close can we get to that? Then at least we're seeing due diligence has been done. The association is serious. They are ready to move forward. They need X amount to keep going. And what can we do to help them meet their guidelines or their timelines? So we look for a little bit of due diligence in the beginning, involving your professionals, whether it's an engineer or contractors. Make sure that you have a couple of bids that are in and compared, so that you can really get an idea of where that ballpark figure is going to be. We always say to go a little on the higher side. You want the contingency, but it's also always easier to go to the bank and say we want less than to say you want more. So a little bit of due diligence up front. Then we're always happy to meet with the boards. We provide term sheets. We try to calm any concerns or any fears along the way. We collect the full underwriting package. We get that into our team, and then you close. And you can close, it depends on the product, but you close fairly quickly. It's all done virtually these days. DocuSign to sign them, and funds are deposited into the account of your choice. There are some nuances to the loans, and we'll get into those in the next couple slides. So some of the questions that I get often, what is the collateral for the loan? And one of the first questions that we always ask associations is, do you have any homeowners that are past 60 days delinquent? And when we ask that, that is because accounts receivables are the collateral that community association banks look at. Local banks or banks that don't have community association divisions almost don't even know what to look at for collateral. You can't take the buildings, you can't take the umbrellas. It's all owned by everybody within the association. So we can't take any of that. The only thing that we can go after are accounts receivables if an association is to default. We've yet to have it. We try to only provide loans that we really feel comfortable associations are able to pay back. So we do our due diligence, and we make sure that we work with you and guide you so that we're not setting you up for failure. That's a big piece as well. We are not going to provide funds that are going to put too much of a strain on the association to pay back. So the collateral is the accounts receivable. It depends on what the loan is, but usually 8 to 10%, less than 8 to 10% delinquent past 60 days. And that's unit number, that's not dollar amount. So if you have 100 units, if you have less than 8 people past 60 days, the quick term loan could be an option. If you have less than 10%, standard term loan. If you have over that, we ask to get that cleaned up before we can proceed. And that's just getting it down under that 8 or 10 threshold. And again, it's unit numbers, because it's a lot easier to go after one unit owner that maybe owes a lot of money than have to go after 20 or 30 people that owe a little bit of money. And that is just HOA fees. It's not any late fees or anything of that nature. It is truly the HOA fee. We want to see that the association unit owners are comfortable with their regular monthly HOA fee. We have board members, and this is understandable, asking to make sure that they're not personally responsible for the repayment of the loan. Absolutely not. The loan is linked to the tax ID of the association, not to any actual individuals. There is a requirement to have a board member, at least one board member, provide their social security number. It's part of the Patriot Act from 9/11, and it really, there's no background check, there's no credit check. nothing linked to your credit. It is a way of proving that there is a physical individual that owns a unit within the association. And it's across the board with any kind of credit. So even credit cards, you'll see it for associations, but that is a legal requirement that we have to handle, but that it just gets housed. Nothing else is linked to that, to your social security number at all. And so no personal responsibility other than making sure that you pay your piece of the loan back. And that's it. And then if the neighbors don't pay, that's a legal action typically. I'm sure the management company would be able to guide you in that situation, but that is where there is where there could be a problem, which is why we actually do have requirements on the amount percentage that one person can own and the number of rentals, because we want to know that there's ownership and that there's care within the association to make sure that everybody's paying their piece to be able to pay back the loan comfortably. And then if a HOA is in litigation, it becomes a little trickier. It depends on what that litigation is. If it's something that's somewhat predictable, construction defect maybe, that's easy enough. We usually just need some details. If it's something that's a slip and fall and it's going through insurance, usually that's something we can work with as well. If there's something outside of insurance or something that could potentially snowball and become a big legal issue, we're going to need some detail on it. It's not necessarily a deal breaker, but it does definitely throw a monkey wrench into the plan. So it can delay it a little bit. And then we talked about why delinquency rates matter. So I think we can go on to the next. And we'll discuss some options. These are typical across the board for banks that focus on community associations. You can go on to the next slide. So lines of credit are not super common in the industry. We do see associations do it. Again, I see it probably a little bit more because I'm in the Northeast. And so we have unpredictable weather. Which an earthquake last week, thunderstorms, tornadoes, all kinds of craziness that you've all been dealing with recently. So there are those unknowns. And these are a situation where the line of credit is a great solution because it's quick. We can turn that around usually in about 5 days. So that's usually a very quick option. It maxes out at $250,000, $1,000 per unit, and a minimum of $25,000. The rate is a little bit higher because you're talking about a line of credit, but it's only on funds that are drawn. So even if you're approved up to X amount, but you never draw funds, you're only going to pay the 1% origination fee and the $250 annual renewal. For some boards, that's peace of mind. For others, why pay 1% if you don't have to? So it's just nice to know that that option is there in case you need it, because there would be a quick turnaround on the time of that as long as the association is in good standing. And so the rate is the Wall Street Journal Prime +1 with a floor of 5%. And this morning, the Wall Street Journal Prime was 6.75. So if you tack on that 1%, you're at 7.75. It's considerably higher than the other loan products. So it really is a backup plan or a safety net. And if you don't have to draw on it, you don't want to draw on it. But you want to weigh whether you need one or not because of that 1% fee up front. And I think that's pretty much it for that one. Next is our quick term loan. This one is actually proprietary to us, but there are other banks that have some similar products. But this we've had for years, in excess of 10 years. It's our quick term product that basically, after about 10 qualifying questions, we're able to tell whether or not an association is in good enough standing to be able to save some of the back office work. And through that, we're able to help the association save money. That it's a flat $500 documentation fee that's taken at closing. So even just to find out if the association qualifies, there's no money out of pocket at all, no commitment. But it's $500 at closing. It's typically 3 days for approval and about 30 days to close. So it's very quick. It's fully funded up front. So you have those funds immediately available when you need them. It's up to a 10-year term, so 5, 7, or 10 years. They are at very competitive rates right now. High 5 percent and low 6, depending on the term. So the shorter the term, the lower the interest rate. And that's typical across the board. So this one has 5, 7, and 10, no prepayment penalty. So even if you took a 10-year loan, we see that associations typically pay a 10-year loan off in about 7 years. And you can absolutely pay it off earlier, depending on if you have homeowners that want to pay their piece up front, or you have some sort of insurance settlement and you want to pay off a piece of it. We can either re-amortize it or you can continue on the way that you are. And so some of the qualifiers for that, this one is less than 8% delinquent, and past 60 days, less than 10% rentals. You can't have a majority owner, so no more than 50% owned by one individual, more than 25 units, more than $50,000. And you can't have a lawsuit for this one. If you have a lawsuit, we automatically have to go into the other product. You have to have the legal right to borrow. And that's pretty much it for that one. Once we know you're over 25 units and the delinquency rate is good, 9 times out of 10, as long as there isn't a lawsuit, you'll be able to get through the quick term product pretty easily. And that's a great one. That's up to $3 million. It's easy for most projects that are coming through. It's usually the one that I start with right from the beginning. And then if we have to go into the other products, we will, but it does cost the association more in the other product. So I try to keep you in this one as much as I can. And the next slide is going to talk about the standard term loan. Couple of things that would push you into the standard term loan. If you need a drop period. So if your project's going to extend over a year, you may want a drop period so that you're paying interest only on the funds that are used at that time. So if you are not 100% sure when it's going to start because the weather's funny, or you have, you have a small piece of the project that's starting now and the bigger piece is towards the end of the year, you may want a drop period. It's not required, but you can definitely have it. It can go out, this one can go out to 15 years. Does have to be over $1 million to be able to do that. And there is a rate adjustment at 10 years, but that 15 years, depending on where your dollar amount is and how many units you have, can be a lifesaver in a difference of what your monthly payments would be to lessen the burden on the association. We typically like to see for this that it's a capital improvement project that has a life expectancy beyond that 15 years. We ultimately want you to be able to pay back the loan and reserve again for the next time that project comes up. That's the rule of thumb that we try to go by to make sure that we're helping you to level set and not to set you back. We want you to be able to comfortably make that payment and reserve and be ready for upcoming projects when they come up. All of the products are fixed rate, so there's no variables anywhere along the way. A lot of very similar qualifications for this one, but the origination and documentation fees do vary depending on how the association grades out initially. Sometimes we have a little leeway with the documentation fee, a little bit sometimes, but it is higher than what you would pay for the quick term. So, and the interest rates are typically higher as well. They're the 10-year treasury plus a spread, and that spread's usually around 2 to 2.5%. So that can be a little bit higher. And then you tack on a higher documentation and origination fee. So I'm always going to try to start with the quick term unless there are things that the association needs, like the drop period or the 15-year term past $1 million. And I can say something important for both of these. Any loan over $1 million would require a updated reserve study, something that is within 3 to 5 years old. And we can go on to the next slide. And the final slide, key reminders. And these are just to make sure that if you're starting to talk about a loan, you want to review your association documents. This I see happen, and it can majorly delay an association. You want to make sure that the legal name that's attached to the tax ID is the same as it is on the governing documents, the bylaws, your tax returns, on everything, because it is incredibly important that all of that lines up with the same legal name and tax ID. If you have not had your reserve study updated, you definitely want to make sure you have that done. You want to consult with your attorney to make sure that you have the legal right to borrow. If your bylaws are clear, they're clear, you're good. But if you have any question, you do want to make sure you run that past the attorney, especially if you need a vote for the association, you want to get that started as quickly as possible as well. Usually you want some solid numbers for that. So we usually come in right before you start the vote process. And then you want to make sure you have competitive bids by professionals that know the industry. We see every now and then that there's somebody in the association that the board would like to use because they'd like to keep it in-house, maybe save a little bit of money. I can tell you most times those don't go well. So it's better just to get industry specific professionals that understand community associations, that know the nuances, that know how to be able to work with you and make sure they have the right insurance and all of that good stuff. It goes a long way with the bank as well, that we know that you're going to have professionals that are going to utilize that are really going to protect you and that are going to make sure that the project happens accordingly. I can tell you, I have walked away from loan opportunities because of construction oversight. I had a situation where an association had a project come up about 10 years early. They had 9 buildings. They had water infiltration. The original construction had an issue, but they were past the statute of limitations. So they knew they needed a loan. The manager and one of the board members wanted to do construction oversight. And it's just something that's not well received from the bank. We want to see that there are professionals that are really walking from that project from start to finish. Doesn't have to be full-time construction oversight, but the managers, you can't put that pressure on the managers. That's unfair to them to ask them to walk on a roof or on a construction site. And they're jacks of all trades. They need you managers, you have to know a little bit of everything, but associations, it is very important, board members, that you bring in a construction professional when you are taking on a large construction project, or an engineer, one or the other or both. But that is much more well received from the bank than than putting a manager in a situation where they should do full-time construction oversight. So let's see, you want to be able to notify your unit owners of what that financial impact is going to be on them. So once you have an idea from the bank what the loan amount is going to be on a monthly basis, how does that fit into the existing budget? You want to take all of those factors into consideration. You want to have the facts to be able to tell the homeowners. And that's huge in keeping the peace for the association and making sure that your homeowners stay on top of their monthly payments, because if they revolt, they may try to push back on that a little bit. And then we talked about board members as signers. One thing that catches up a lot, and I've been surprised about this, is expired driver's license. It happens often. So if you're going to be a signer, double check your license and make sure that it's not expiring anytime soon. And make sure that your insurance for the association is up to date as well. And if all those things align, you should be able to get through the lending process fairly quickly and fairly painlessly. Any questions? I think that's the last slide.
I have one.
Yeah.
My association, last year, we have troubles with reserve funds covering what we need because maintenance had been ignored for a long time. And we're entering into a major linchpin project that will be 4 phases and will go 5 years. And it has to be covered because water is intruding into units at the ground level with the extreme storms. So that's the setup. We decided as a board, and we have started the first year of it, to do 5-year assessment plan.
Okay.
And communicate that to the community. And we're doing that. But I'm listening to all of your loan part here. How would the way that we're going about it, which each year pays for the phase that's getting done this year, if we had chosen to do a loan to cover the 4-year, the project, the big project, and then we're paying out forward because it's a loan. Is that correct? How would they compare financially?
So if you
Feel
are,
far more secure with paying for it as we go.
yeah, so if you're able to comfortably pay for it as you go, I always say if you're taking out a loan, you are definitely paying more for the project than need be. So if you are able to do that with the reserves that you currently have and the contribution or increase or the contribution that each unit owner is making annually, and the project is likely going to extend out that 5 years anyway, I wouldn't recommend a loan in that situation because of
Yeah.
the fact that you will pay that interest difference. And if you don't have to do that, then why do that to yourselves if you don't have to? I would keep the line of credit in the background, in the back of your mind, in case you come across a situation where you end up needing additional funds. There's a part of the project that for some reason is more expensive unexpectedly. You can always do something like that. But if you don't have to pay that loan difference or that interest difference, and everybody's staying current with their HOA fees, then you're on track. I don't think I would do anything different.
I wanted to hear whether your logic matched my logic.
I'd like to say you're a smart lady.
Back to the list.
But yeah, no, I mean, it sounds like you're actually on a very good track. It's a unique situation. It's not often that we have associations that can do that and truly stay on track. And I applaud that actually. So,
Well, we're beginning it, so we don't know if we're staying on track yet.
well, at least you have a backup plan if you need it. You can always call me and we can talk through any option that you need at that time. But so far, I would go ahead with that plan.
They were planning for each year, and we knew that we were going to have assessments every year. So we thought that we'd make our big plan based on these figures,
Mm-hmm.
knowing that that was the plan that was going through for people to plan on paying each year.
Yeah, no, it's a great plan. And again, you have some backups if something goes awry.
Right. Thank you.
Any other
Nicole,
questions?
if I could go back to the investments for a minute, I apologize if I missed it, but can you give us a rough comparison of the earning rates, right, on an ICS versus the Cedars?
Yeah, so ICS, you're going to be very comparable to a money market rate. You're less than 1%. So I always encourage anything that is excess that you don't need for the next 3, 6, 9, 12 months to be put into a CD because you will get a better return. But because your liquid funds in an ICS would be somewhere, it depends on the balance, but it's between 20 and 45 basis points, so 0.20 or 0.45. So you definitely, when you're talking CDs right now, you're between 3.25 to 4%. So you definitely want to say, okay, what can we put into a term product and do a term product? And right now, actually, our 30-day, 60-day, and 90-day are at 4%. So if it's a short term, you don't need the funds for a month, you can get 4% on them.
Okay, great. And then you mentioned the ICS would convert the reserve funds or the operating portion, if you will, to a checking account. So do you completely lose interest on the checking account?
So what I try to do, because the quick answer is yes, the funds would go from money market to operating. So you'd lose a little bit of interest, not much, because it's not a drastic difference of what you're earning in the money market. But we internally within First Citizens, we have to have 240,000-ish before I can take advantage of the IntraFi products. So I try to structure your accounts in a way where as much sweeps out as possible to get that money market rate than sitting in a checking account earning 0.05. So that's why whenever there's an ICS question, I always like to be involved so that we can talk through, okay, how do we structure this so that we can make sure we still maximize the interest return for you while still protecting everything fully.
All right, thank you.
Yeah, you're welcome. Great questions. Anything else I can assist with?
I wanted to say, I appreciate you so much, Nicole. You did an excellent job presenting all the different variations of ways that we can help our board members. And just as in general, I think it's we have our KS perks. One of those is having people who have this wealth of knowledge like Nicole. And notice if she would have been here, she would have been flying in to be able to have this conversation with you. And we don't take that lightly. We actually make sure that we find the best people that have the best resources for board members. And I think that's something that we're really proud of. And there's a lot of different perks that we have to go along with that. Brad's in house to talk about mortgage rates as well and different options for you for your home. Anything that you have, if we don't have it available, just talk to us and maybe we can see if we can put some things together. I really enjoyed just learning about all the different variations of help that you can offer, especially from making the money make money and actually make your accounts even more stronger. But also when it comes to needing a loan and if that decision is good. And I like the fact that you turn people down. I think that's integrity, right? Like, yeah, exactly. So that's one of the big things that we count on too.
Yeah, absolutely. We're here to guide. We're a support to every manager in this room and every board member. We are here to support you. We take it extremely seriously. We know the nuances of associations. We know the dangers that can be out there, and we're here to help in any way that we can. I'll always be honest and tell you if we can't, or if you should, or if you shouldn't. And so just never, ever hesitate if there's any way that we can help.
Awesome.
I wish I was there. I miss you all.
And we'll distribute this recording, this PowerPoint deck. Nicole's contact info will be in there as well. As I mentioned before, she's great at just meeting with you guys if you want to talk through loan projects or earning more interest on your accounts. Whatever the question is, she'll gladly attend board meetings and help with that.
Avery's got a question online.
The chat. One of my great board members in Mill Creek, Craig Farron, asked why and how did KS hire First Citizens in the first place?
First Citizens. I think when you guys started with us, we were either still Mutual of Omaha or we were definitely CIT when you started with us, but we may have even been Mutual of Omaha. There are, and I mean, I can only speak to our side and maybe Lee can speak on the other side, but there's only a handful of banks that really focus on community associations. And it is a unique industry that is misunderstood by most. There are unique protections that need to be put into place. There's guidance that needs to occur. We process homeowner payments. So if you're paying them through Vanica Pay, it's a little bit different. But if you're paying through Lockbox, where you're sending a physical check, you're actually sending that check to us and we're processing that payment. We integrate with the software Vanica to make sure that KS has the most accurate information as quickly as possible about homeowner payments. And then being able to provide the holistic relationship of the lending piece and the reserves is a big piece as well. We focus solely on community associations. So again, there's only, I'd say maybe 9 different banks across the United States that have some level of service. And we have the whole package. Some will have just payment processing, some will have just lending, but we have the whole relationship. We do everything free of charge because we understand homeowners should be able to send a payment in. We know that you may need guidance with lending and reserves. So by doing that free of charge, we're working with the management company to make sure that we're providing that education and that assistance. So I can only speak to that side of it. I wasn't there for the original signing. So I don't know what the tipping point really was, but that's just a little bit about what we offer and why First Citizens kind of stands out in this industry.
Yeah, and we have been with First Citizens since they were Mutual way back in the day. So we've gone through both acquisitions. And honestly, they are the best of the best. Nicole mentioned it there. She's not going to toot her own horn too much. But we, same as you as board members, have a responsibility to go out and shop things and look at what's available to your association. We as a management company do that as well. So I've personally shopped other banks. Nicole's aware of that. And we always stick with Nicole. They have the best products, they have the best services for associations, and they've never let us down.
Sometimes they send us ice cream cake too.
Yes, which speaking
So
of
always
which,
be
there's
something
ice cream
sweet.
cake. So anyone that is here in person, Nicole sent cake for us.
Also motivation to come into our headquarters and come to the seminars in person.
Hey.
Absolutely. Well, thank you so much for your time and for understanding. It was a harrowing experience at the airport yesterday. A number of hours delayed, and it was it just wasn't working. So next time, I promise I will be in person, and we'll always make sure that there's some sort of cake. That's number one rule in my world. So,
All right, thank you, Nicole. Thank you, everybody,
Thank
for
you
your
so
time.